What are some other things that you've seen that help promote a more inclusive ecosystem around entrepreneurship?
I think it's a few things. I think if you're running an investment firm or an entrepreneur support program or doing anything that cares about entrepreneurship, you need to first make sure the entrepreneurs who are at the table represent the problem you're trying to solve. And so a lot of people, when they think about entrepreneurship, will say, hey, I'm going to get a bunch of smart people in the room. We're going to figure out what we want to do. We're going to go out and find deals, and we'll figure out who to invest in. There are all kinds of implicit biases in what I just said. Most people, when they look for entrepreneurs they want to support, they talk to their network. So if you are an entrepreneur and you don't know anybody who has money, you're not going to be found in that sourcing mechanism. So making sure you're finding people who don't have access to social capital is really important. Access to financial capital is important, but also the right kind of capital. So we have this thing called venture capital, and most of whether it's Shark Tank or pitch competitions, most of the very high profile things we do around entrepreneurship are focused on venture capital. Venture capital is just 1% of all businesses. Dell and Best Buy and huge employers in the Fortune 500, Walmart, never raised venture capital. There are lots of other ways to start and grow your business besides raising venture capital. So if you want to start a restaurant, or if you want to start a cleaning service, or you want to start agriculture improvement in Kentucky, you may not need to or want to raise venture capital. So other sources of capital, like whether it's a Kiva loan or whether it's a specific grant targeted to a particular program, need to be in the conversation.
How do we help entrepreneurs? Because I don't disagree, but I do think sometimes entrepreneurs, when they talk about their business, they kind of buy into the Silicon Valley venture capital, that if I'm not seeing hockey stick growth, or if I'm not pursuing equity, then my business doesn't really matter. And so they discount, even themselves, they discount the value of potentially grant dollars or debt capital, or just bootstrapping it and pursuing revenue over equity. What would you tell those entrepreneurs, and how do we help them understand that those businesses matter to communities, and they don't have to have the next Facebook to be a successful entrepreneur?
Well, the reason why entrepreneurs are promoting hockey stick growth, venture capital, make you 10,000 times your money and create the next big hot tech thing in your communities, that's what the most visible people with money are asking for. Venture capitalists are out there. They say, we have money, we want to invest in you. And if you come to me and say, I'm going to grow 5 to 10% a year over the next 30 years, a venture capitalist will say, that's not good enough, I need to see hockey stick growth. Yeah. And so an entrepreneur goes back to them and says, well, now I've created the fake projections that you asked for, I'm playing your game, am I investable now? I think people respond to incentives, and right now entrepreneurs feel like the market is not giving them incentives to build a normal growth business. They either have to go for 10,000 times return and likely fail, or not even have a shot at all.
Well, you mentioned normal growth, so I am curious, as far as entrepreneurship and inclusivity, how are the term sheets themselves exclusive? So, because what I've seen historically is that statistically women over the long term lead more successful companies, but the way term sheets are even written, it excludes them from that opportunity. So where are the conversations around just the changing landscape of term sheets and making sure that capital is available for what you just described as a normal growth company?
So we have this thing called the venture capital process, and it's so logical and it's so wrong. The venture capital process says that most businesses fail, and as a result, to make money as an investor, you need to make a lot of money off of the businesses that succeed. And then when you think about that, follow it to its logical conclusion, that actually massively perpetuates income inequality, because a few people will do very, very well. Most people will put their life savings into a company and leave with nothing. That's a problem. And so there's a different narrative, which is most businesses will be reasonably successful. most people who participate in these businesses that are fundamentally strong and grow 5-10% a year will make enough money to provide for their families and send their kids to college and the things that they want to do. And that's a better narrative for a community where most people are doing pretty well rather than a few
Right.
people doing amazingly well and most people doing nothing. So if you look at, for example, I've seen investment structures where I will invest in you and I will get a share of the revenue that you have. Our incentives are aligned for you to grow in revenue. That's a structure that I think is much more likely to make me some money as an investor. It is less likely to make me a billionaire as an investor, but it's more likely to make me a profitable investment firm.
Yeah.
But people don't pursue that because that's just not the narrative by which we fund startups.